You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
All right, everybody, that music means it's time once again for Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name is Mark Longo from the optionsinsider.com, as well as, of course, from the ever exciting, at least we hope so, Options Insider Radio Network. Hope you guys aren't sick yet of all the slew of content we've been sending you guys from the Options Industry Conference. We did a lot of shows down there. They're all hitting the network over the last couple of weeks as we speak because we have more great guests in store for you, including our next guest. She is a newcomer to the program and indeed to the network. She is Mandy Xu, the Chief Equity Derivatives Strategist over there at Credit Suisse. Mandy, welcome to the Options Insider Radio program.
Great. Thank you for having me.
Oh, I just met with your colleague a couple of weeks ago. It seems like yesterday. Pat, he has a great name. I can't remember it. Lingo, something like that.
Yeah.
I remember it resonated with me. It was a very powerful name. and he spoke highly of you, and I had seen your presentation at RMC, so I had made a mental note to bring you on as well. So I think the fates just aligned to bring you to Chicago here to the studio. So Mandy, as we are wont to do with all of our first-timers here on the network, why don't you go ahead, give us a little bit of an overview of your background in the derivative space and how you found your way over there to Credit Suisse.
Sure. I actually started out my career at Credit Suisse and always on the equity derivative strategy group.
Oh, you're unusual then. Everyone on our network usually has, 15 different things they've done.
I'm a little boring in that sense. But, I've been with the group for 8 years. I currently run the group now. And what we do, we provide quantitative analysis and derivative trade ideas for our institutional clients. So that's, anything ranging from hedge funds, pensions, insurance companies, all the way to your traditional asset managers. And my focus in particular is more on the macro side. So I'm, mostly specializing in index and ETF volatility, with also an eye on cross-asset volatility. So anytime, there are divergences, between, say, equity vol and rate vol or FX vol, that's something that I like to look at as well.
Equity derivatives research, a bit of an esoteric niche. How did you find yourself? Did you study that at school and want to do it, or did you land at Credit Suisse and they said, hey, we have an opening on the research desk for derivatives? How did you find yourself in that particular vertical?
Yeah, so through kind of the traditional route, I did an internship at Credit Suisse the summer after my junior year and rotated a couple of different desks, but one of them was the equity derivatives desk. And I just really liked it. It was, I like the fact it was on the trading floor. The product was more esoteric than, straight up buy or sell, right? So, you care in the derivatives world, not just whether a stock is going to go up or down, but how much, the magnitude of the move, the timing of the move, all of the different Greeks that's associated with it. I thought that was, super interesting. So that's how I, ended up on the desk and, happy to be there.
Everyone has a similar story, I think, that came to derivatives. And for me, I took a class in it.
Yeah.
And I said, well, these things are much more interesting than stocks. You're right, because they can do more than go up or down. Next thing I knew, I was standing in the SPX at the SIBO. So we've all made our terrible mistakes in life. That one kind of worked out, though. It was fun. It set me on this path. Well, speaking on this path, let's start with some current events, Mandy, because you're here right now as we're talking. The market kind of unched a little bit. Volatility is selling off. We're heading into a long holiday weekend that usually is a little bit weighty on the volatility side anyway. But everyone's asking us, so I will turn it to you. You do a lot of research in this space. Everyone's wondering if, February 5th, a bit of an aberration, or was this the beginning of a new higher volatility regime. It seemed like it was. It seemed like it's maybe that's not so much the case anymore. It's kind of if I had asked you a week ago, probably would be a different question entirely. But are you thinking this is kind of the trend now? We're going back to the old regime of somewhere in the low teens to maybe even, dare I say it, single digits again? Or are we heading back north to a more stable mid to high teens? What is your research telling you?
Yeah, no, I think this is clearly, the number one question that everyone is asking. So our view is that based on the fundamentals, volatility should normalize, but that doesn't necessarily mean that it's going to go back to, single digit like what we had last year. That was very much, I would say, also a tail event on the other side for the market. But if you look at what happened in February, so we were out saying at the time that it happened that it was very much a technical dislocation in the volatility market, not really based on fundamentals, right? So if you look at what happened that Monday, Feb 5th, people like to talk about, was it due to inflation fears, et cetera. It wasn't, and there was nothing macro, no macro headlines that came out on that day. If you look in the rates market, rate volatility was actually down on the day that, the VIX had its largest one-day move. We think it was very much a liquidity event in the market. But because of that, because there was no turn in the fundamentals, our view is that, it should normalize going forward. But the reason I don't think it's going to go back to kind of like what we saw, the lows we saw last year is, if you think about like the fundamental drivers of low vol last year, it was very much a function of the fact that we were seeing synchronized global growth across the major economies. Well, right now, not so much, right? Like U.S. is still doing pretty well, but the news today that came out, European PMIs again disappointed. I think the expectation is that things are going to pick up in Europe going forward, but if it doesn't, of course you also have the emerging market, what's going on with Turkey and Argentina, and maybe broader contagion. So I think when you start to see cracks in kind of the growth story in different parts of the world, that to me is a fundamental catalyst for a bit higher vol. So we think, our base case scenario is for the VIX to be in the 10 to 15 range going forward.
So a nice kind of range-bound volatility market. It is kind of funny when President Trump first came into office. Everyone, including myself, everyone who came on this network in that beginning of that year, they had one unanimous. I never heard such unanimity of opinion on anything in my life. Everyone said effectively this. They said, Trump, he's not a single-digit VIX president. Whatever we can expect from this guy, certainly more volatility is a given. And what did we see for the entirety of that first year was the exact opposite, the complete death, the erosion of volatility, a little bit of a blip in February again, and now we're heading right back down that path, which is kind of interesting. I was at an event last week, and there was a speaker there talking about this and saying, what we saw in February was, if you look at like a pure normal distribution of the market, was a once every 200 some odd year event from a VIX move perspective. And he said, how many people here think we're not going to see this again in the next 200 years? And no one raised their hand. And so he said, hey, Greg brought up a good point that, A, maybe you shouldn't look at a normal distribution. Probably the markets aren't very normally distributed. But that B, that, we're in these kind of crazy periods going forward, that there's a lot to expect. Maybe not once every 200 year moves, but a lot more going up. I know you do a lot of work. Also, you kind of mentioned the different factors there with correlation in the marketplace. That's kind of a big area of research. And we've seen that a lot on our volatility programs and others as being a big driver up or down of volatility. I know you were talking a lot, doing a lot of research toward the end of last year, that correlation in the different S&P sectors was kind of what was keeping volatility muted, somewhat tamped down. I'm sure you've been keeping an eye on that since then. How is the correlation shaping up right now? And is that another factor you think that's contributing to this general ebb in volatility post Feb 5th there?
Yeah, so correlation is clearly a huge component when it comes to volatility at the index level, right? And as you mentioned before, last year, one of the fundamental drivers of low vol, in addition to kind of the constructive macro economic background, was the fact that we had record sector dispersion. So what that means is that, even though S&P, vol, like VIX, was in single digits, there was volatility in the market last year. It was happening at the sector level with financials, with tech, with energy, et cetera. But because these sectors were all moving in different directions, at the end of the day, you often get S&P unchanged, or very small moves in the S&P. So I think that clearly was very constructive to the market, and I would argue one of the reasons we had such high sector dispersion was because of Trump. right? Because of all these fiscal policies that were coming out, people were wondering, who's going to benefit from tax reform? Is Obamacare going to get repealed, and what does that mean? So I think, the fact that we had new fiscal policies coming out at the same time as a very constructive macro backdrop were all kind of the fundamental reasons for low vol. Now, fast forward to this year, it's actually been the complete opposite. So with the February vol dislocation, we've seen a very strong pickup in correlation across sectors. So again, if you just look at the market these days, you'll see, sectors are typically moving together, right? Like they're all up or all down. Very, very little dispersion. That the measure that we look at, the correlation, 3-month trade rolling realized correlation between the S&P sectors went from basically an all-time low last year to now around 70%. So from 20% to 70%. So a pretty big jump. Now going forward, I think as long as kind of the economic and macro backdrop remains benign, we would expect that sector correlation to start normalizing as well. So one of the things that we've been talking to clients about is looking more at sector-specific ideas, right? So not just punting on where the S&P is going to go up or down, but kind of picking out your favorite sectors that you think will do better going forward. So for example, if you're concerned about higher rates, maybe look at the financial sector or energy. Pick out the sector-specific stories, because I think again we might be returning to a world where sector moves are going to be bigger than the index.
That's the old saw about correlation, right? Is when it all hits the fan, a correlation goes to 1 across the board.
Exactly.
Everything moves in lockstep, and all these well-planned, well-thought-out diversification programs across 30 or 40 different quote-unquote non-correlated assets. Guess what? When it hits the fan, they're all correlated, and they all go to 1. It's a great argument for derivatives, by the way, because you know exactly what you get in those environments. You buy a put, it's not going to go to 1. It's going to stay at whatever it is there on the board. So that's at least a nice thing. Now, Mandy, I mentioned one of the things that maybe want to bring you on was I was down at RMC a few months ago. It seems like more recent than that, but it was actually a few months ago. And you were giving a presentation there with Bill Speth from the SIBO, and you were running down a lot of interesting things, which kind of caught my ear because they were similar to a lot of things we say on our volatility show a lot. Whenever people write into us and they talk about these broad volatility topics like VIX. What is VIX right now? What is VIX? Is it too high or too low? There's all these other things that have to go into it. Contextual things like skew and S&P and where the futures are. All these other things. And you kind of broke a lot of that down in your presentation, which was nice. A, to hear someone else saying that, and B, I thought it would be an interesting thing to bring you on. So why don't you come ahead and break down that presentation you gave at RMC for us? What were some of the highlights, the key drivers you saw of volatility in the contextual realm?
Sure. So I think the main point is that, people look at the VIX as a gauge of risk or how much risk the market is pricing in or, expecting. And obviously last year we went through a year of record low levels of VIX. And I think the prevailing narrative in the media, at least, was that, investors were very complacent and not really looking at appropriately pricing in potential risks to the market. And really my presentation was kind of making the point that the VIX is not really the best measure of risk in the derivatives market, right? So what it is really is a measure of 1 month implied volatility of the S&P. So it's very much short dated, and it measures just that, implied vol, which is uncertainty. It doesn't measure sentiment. It doesn't measure positioning. It doesn't tell you if people are buying puts or calls, which are very different, right? And if you look at some of the other measures in the derivatives market that I think are more useful, or at least you should look at in conjunction with the VIX, though all of those other indicators were at record levels or at very elevated levels, telling you that people were pricing in potential downside risk. So for example, skew, which is a measure of demand for puts versus calls. Skew in the S&P last year, especially for the longer dated tenured options, were all very, very elevated, like around 1-year highs, right? So what I was telling you is that people were hedging. They were not, buying 1-month options, but they were hedging, 3 months, 6 months, 1 year out. Other measures, for example, we look at is vol, which you can track with the VVIX index, right? That tells you volatility of the VIX, but in essence, the perceived tail risk to the market. And what we saw last year was that even as VIX was making all-time lows, VVIX was actually trading at relatively elevated levels compared to the VIX. So that ratio between the two, VVIX divided by VIX, that was an all-time high. So essentially what the market was pricing in was an extreme high jump risk to volatility, right? So saying that even though the VIX was at 9, 10, 11, all it takes is that one event for VIX to go to 30 to 40. And when it goes there, it's not going to go there, over the course of a week. It's going to go there in a day. And that's exactly what we saw happen in February. So the point there is that, there are a lot of aspects to the volatility surface that the VIX does not capture. And if you really want to get a true sense of how much risk is being priced into the market, I think it is important to look at those other measures as well.
I know a lot of different houses and shops out there, they kind of have created their own alternative VIX, if you will. Some measure how far out you have to go to buy a put, to pay for a call, or all these different proprietary ways to effectively deliver something along the same lines. Do you guys have one of those at Credit Suisse? And if not, you mentioned VVIX, that's one of our old standbys. We talk about that all the time on our volatility show. Do you have maybe a preferred way of measuring VIX yourself? Maybe you're more of a realized volatility person. You like to look at hedge straddles in the marketplace. What is your preferred measurement or methodology, I should say, to really look at the market and gauge volatility outside of just cash VIX or the VIX futures?
Yeah, so I think it's important to look at a variety of indicators. I don't think any one indicator is going to give you a full picture, right? But at Credit Suisse, we do have our proprietary measure of sentiment. It's called the CS Fear Barometer. You can look it on Bloomberg under the ticker CSFB index. And what it is really a measure of skew in the market. And what it does is, unlike the VIX, which looks at very short-dated options, the CSFB index looks at 3-month options, which is typically the more common tenor people use when they go out and hedge. And what we're doing with the index is we're pricing a zero-cost collar. So we're looking at, if I sell a 3-month 10% out of the money call and take that premium to buy a put, what is the strike of the put that I can buy to make this whole strategy net zero premium? Obviously, more demand there is for downside protection, the more expensive that put is, and my strike is going to move further out. So the higher the level of the index, that means the higher the demand for protection, the more expensive downside protection is relative to upside call demand. Therefore, we say there's more fear in the market. And obviously, the reverse is true. So when the index is low, it means that people are not willing to give up the upside in order to get the downside protection. So we like that as a measure of sentiment because it forces an explicit trade-off between the upside versus the downside, which the VIX doesn't do. And also, because it looks at 3-month options, I think it gives a little bit more a better measure of kind of typically when people go out to hedge. And if you look at the index, the interesting thing you'll notice is if you pull it up for the past year is that in February you can barely see a blip on that index. It remained relatively stable, and I think that's pretty telling in that February was a dislocation in the market. But there wasn't any change in terms of the fundamentals. And as a result, in terms of positioning, we didn't see people coming in to, panic sell or dump their, core holdings, or we didn't see any panic buying of downside protection either. So I think, if you look at VIX, you would assume that everyone was panicking. There was a lot of short covering going on, et cetera, et cetera. But that's not what happened. And I think if you look at the CSFB, that will kind of give you a more accurate picture.
The VIX obviously a little bit shorter term, so it's going to react a little bit more aggressively to those swings too. Pushing it out 3 months or so will certainly help too. I knew someone had a 3-month barometer, and it was you guys.
That was us.
I've seen so many of those come across, and they all kind of get lumped together in the brain. Is that your brainchild? Is that your creation, or is that your team?
I wish I personally could take credit for it. It's not, but it is our team who came up with it. So and it's been around for a while, and I think a lot of people do look at it as kind of a supplemental measure or gauge.
Certainly, when you're looking at demand for these products, skew is one of the first things we say. So having an indicator that incorporates that is an interesting one. Speaking of interesting things, one of the things I've noticed, I'm sure you've noticed too, making the rounds at the various volatility conferences and events is, at least going into February, for the a year and a half or 2 years preceding that, it seemed like the entire world had just fallen in love with the quote-unquote harvesting of the risk premium. Every event you went to, it's like all of a sudden everyone woke up to selling puts again. Like this was a new strategy that had just been invented in 2017. Look what we discovered. I think not this last RMC, but the year before, 3 out of every 4 presentations were look at 5% out of the money puts in the S&P. Yeah. Look how much you could get by selling these. And all of a sudden that went away, surprisingly. But I'm curious, did you have the same feeling? Do you think the world, did your clients maybe over there on the research side, were they coming to you saying, hey, we want to do this novel thing of selling puts? Is that something you noticed as well? And do you think also maybe the February 5th events have mitigated that somewhat, or are people back in the harvesting of the risk premium mindset again?
Yeah, so no, definitely I would say, by far the kind of the biggest increase in activity that we've seen or in interest over the past 2-3 years has been on the vol selling side, and particularly, selling volatility as a source of yield. I would say, when February happened, the headlines, at least in the media, were talking about, oh, this is the blow up of the short vol trade, and people were going to really learn their lesson and learn their risk associated with it. I would say it's different. So I think the short vol trade is a term that people use to encompass a lot of things that maybe shouldn't be bucketed together, right? So in February, when the dislocation happened, strategies that were hurt were strategies where the P&L is tied explicitly to the level of the VIX. So obviously the VIX ETPs, but also, if you're selling S&P variance, right, whether against another index or what have you, these relative vol strategies, they did not do well in February. But the vast majority of short vol trades that we see going on is the yield enhancement strategies that you talked about. So for those, if you're a call overwriter, yes, technically you're short vol, but were you hurt in February? Not really, right? Like, you kept the premium, right, that you sold. Market went down, but you did better than someone who just held stock. Similarly, if you were a put underwriter, right, if you're doing selling cash covered puts, you did better than the market. So I think, people talk about short vol and like, oh, if everyone's short vol and VIX triples or what have you, then they'll be they obviously didn't do well. But I think if you're doing it for yield enhancement, if you're doing it without leverage, if you're doing it in limited risk fashion, you're actually okay. And on our desk, at least, kind of the clients that we talk to that systematically sell options for yield, they did not stop. They, have continued to do so, and they weren't really hurt by the move in February. At least not so as much as I think what the headlines would suggest.
I think there's two results we've seen coming out of that. Some people just got scared and they got the heck out of Dodge. But you're right. The people who had level heads, it was a very, it was an aberration. And kind of most of it mitigated within a couple of sessions. So if you kept your cool and you kept the level head, it was a scary couple of days probably. But then if you could weather that, then you're right. Then you're back to doing well and outperforming the underlying. So we've seen interesting responses. That's why I kind of wanted to gauge your client response. Sounds like they haven't been deterred from harvesting of the old risk premium, which was an interesting conversation even last year. Of course, people thought when VIX is hitting single digits that it was a bad year to be quote unquote harvesting the risk premium. Yet realized vol was somewhere in a 5 to maybe a 6.
Yep.
So there still was about a 3.5 point premium in the market, even though it didn't seem like it was at the time. So it is an interesting strategy. Interesting to watch the evolution. Everything old is new again in the volatility markets. All of a sudden, I've been going to these events for years, and all of a sudden, everyone wanted to sell puts. It was an interesting moment over there on the show. Speaking of on the strategic and on the tactical end, do you guys have a particular go-to you like to recommend out there in the volatility in the VIX space? I know for a long time, at least until the latter portion of last year, we saw a lot of people were very much enamored with the 1x2, short 1, long 2 in the VIX call space. That was the trade du jour that everyone was doing, and it worked out pretty well until it didn't. And then last year wasn't really a very favorable time for it. Maybe it's setting up a little bit again now that we're starting to drift back down there a little bit again. But do you have a go-to with your clients when you're talking about different, or does it vary? Like we mentioned before, depending on the different contextual things that are going on in the volatility space, do you have an arsenal, a suite of tools you like to use for various volatility regimes?
Yeah, no, I think obviously depends kind of on the underlying, on the directional view of the client. But in terms of, if we're talking about kind of my favorite idea in VIX right now, I think if you're looking to hedge, and certainly, there's a return to kind of a pickup in interest in tail risk hedging, given what happened in February. So the trade that we really like at this moment is doing a call spread collar on the VIX. So for example, you sell a 12 strike put. So let's say this is going out, June or July, you sell a 12 strike put, you can buy, I think when we looked at it, it was like an 18.25 call spread for net zero premium or very little initial premium outlay. If you don't get a VIX spike, right, that's fine. You don't lose anything. If the VIX kind of settles below 12, then that's when you're kind of exposed to losses on the downside. But if your view is that we're probably not going to return to the extreme low vol regime that we saw last year, and you're comfortable selling that 12 put, I think that sets up well. And on the upside, obviously, you capture kind of VIX moves back to kind of the mid 20s.
I like that. I've always been a fan of the bullish risk reversal. We haven't seen it as much out there in VIX land, but I think maybe at these levels, you're right, it certainly does make some sense. The downside risk is certainly far less than the potential to grab things on the upside. Well, Mandy, I know you guys are working on a lot of interesting stuff over there. We talk correlation, we talk your different contextual volatility clues that you guys use on a regular basis. Any other interesting research that's coming across your desk you guys are working on? Maybe you want to give our audience a little bit of a peek, a little bit of a tease, a little hint, a little insight into?
Sure. I'll touch upon something that's more tactical. And I mentioned earlier on the show that I look at volatility across asset classes, and I think right now the interesting divergence that we're seeing is in emerging markets, right? So obviously with Turkey and Argentina in the news, what we're seeing is not surprisingly a pickup in volatility in, for example, emerging market FX, emerging market bonds, emerging market credit. But what you're not seeing is a pickup in volatility in emerging market equity. So during the say the past 3-4 weeks, we've seen, EM, for example, EM FX vols go from near 1-year low to near a 1-year high, whereas during that same period, EEM, so the EM equity ETF, that vol has come in actually quite substantially. So not only has volatility in EM equities gone down, but there's also not a lot of pricing of downside risk. So skew in EEM is also very low. So I think that divergence, something isn't right? So you can't have, all these asset classes tracking the same region, responding to the same macro risks, sending very different pictures. So what we're recommending is that, if you're looking for a hedge, we really like buying downside puts in EEM, given kind of the macro, the macro stress we're starting to see in the FX and credit market there. And also, EEM is more vulnerable to, for example, a slowdown in global growth. So you're someone who's worried about growth maybe not picking up around the world, that would be a good place to buy downside protection. And last but not least, if you're someone who's worried about trade, right, as a source of risk to the market, obviously EEM is massively vulnerable to an escalation in trade tensions between, say, the U.S. and China. So all of these reasons, all of these macro risks not currently being priced into emerging market volatility and on the equity side. So that's kind of one area that we've been spending a lot of time in.
Well, Wendy, I'm glad we can get you on here on the show. And, Pat sung your praises, so I'm glad to finally get you on. We'll have to get you rotated onto our volatility show one of these days so we can get a lot more into the weeds in terms of tactics and strategy and what's trading right now. That said, you gave us a little bit of an insight into your research. If you want to leave our audience with anything else, a hint, a tease, an upcoming appearance, maybe something you guys are working on that they should stay tuned to, now is the time. The floor is yours, Mandy.
Well, if you missed the SIBO RMC presentation this time, I will be also presenting in the Europe conference, I think in September in Ireland. So that would be the next big conference.
They keep trying to get me out to that one. I've never made it. I missed Lisbon. I missed all the European ones. So I'll have to, you're saying it's worth the trip, and I might have to head out there one of these days.
This year it's in Ireland, I believe, in Dublin. So I think that would be fun.
There are worse places to be. Well, there you go. Check it out, and you can of course check out Mandy and the rest of her team's research over there at Credit Suisse, and we'll look forward to having you on our volatility show so we can dive a little bit more into the weeds of all this esoteric volatility fun.
Great. Looking forward to it.
Thank you.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.